So it's interesting what we observe and learn when we're, looking into a new company. You know, as a business consultant, I do this all the time, but my favorite story is from a really long time ago. There was a company who reached out to the firm I worked for at the time and wanted us to buy them. And so the principals went down and had a meeting with them, sat down with them for a few hours, had long discussions, learned about their business. They learned about ours, see if they were a good fit and everything. And on the way out of that meeting, which I wasn't there at, but I did hear this story, the principal turned to one of his partners and said, "What'd you notice during that meeting?" And the younger partner said, "We were there for 3.5 hours and the phone never rang." Exactly. What does that mean? So, how many times do you have 3.5 hours where your phone doesn't ring? You're not interrupted from a meeting. So that tells me a lot about your business. Now, it doesn't tell me everything about your business. So sometimes we get these anecdotal evidence about companies, and if we're going to extrapolate that and say that is everything we need to know about them, of course, we're wrong. However, intuition often tells us plenty about whether or not we want to ask any more questions. Now, when I get hired, owners always have questions for me. And one of the questions they have is, do I need to hire more people? Do I need to buy my own building? Yada, yada, whatever it might be. And my answer is always, I don't know. Let's take a look at your numbers. So today, I want to talk about what your numbers tell me.
Welcome to your weekly dose of uncommon sense, helpful insights, and tough love. I'm your host, Tom Stimson. The Intentional Success Podcast comes to you through the generous support of Mertz Crew.
Mertz Crew helps top AV companies book quality AV freelancers. Your choice, your rates. We handle contracts, insurance, and payments. You save time, cost, and reduce risk. Start today at mertzcrew.com.
Now on to the show.
Folks, I've got a confession to make. When I started doing this consulting thing 20 years ago, and I sat down with a new client's financials, it took me a week of pouring through those things to try and understand them, figure out what numbers went where. Every question I asked, I didn't know how to get the answer. I had to learn how to get the answer. And part of it was a lack of experience, and part of it was I just didn't know the right questions to ask. And over time, after looking at them, the numbers started telling me what questions to ask them, and I got better and better and better at it. Today, when I start to work with a new client and begin the deep dive into their business, 75% of my analysis, 75% of everything I need to know about their business and how they work and how they think, even the culture of the business, I can learn in 2 hours or less looking at their financials. I review financials. I do it all the time. I look at your profit and loss history. I look at your statement of cash flows and your balance sheet, and they aren't exciting, but they are revealing. So my goal for you is to help you learn how to review your own financials and learn how to track the numbers that really make a difference, which is, why I'm holding a master class on management accounting. I'll talk more about that a little bit later, but keep listening. I want to share some things that I learned. So the 5 most important things I look at right now are not the same things I looked at 20 years ago. Let's go back to 2005. Here's what I looked at. Here are the key performance indicators I looked at in 2005. First thing I looked at was revenue to full-time equivalent employees. How many employees did it take and how much revenue? And I knew that if that number was low, you might be overstaffed. If the number was high, you probably needed to add staff, right? Because you were going to be inefficient and not operate profitably. But the fact is, the companies that had a high revenue FTE were often very profitable, but maybe they were a little bit stressed because their processes were built on everybody working so hard. But I looked at that number. I looked at sub-rental as a percentage of revenue expense because, well, at the end of the day, we're all rental businesses. And if you were sub-renting too much, you needed to own more equipment and so that you can keep that money. So could your sub-rental expenses actually be buying new equipment to reduce that number? I looked at your total labor as a percentage of revenue. Back then, it was generally about 30%, just to make sure that we were putting enough people on shows. It wasn't really about profitability. It was about, we're recruiting things properly. And then I also looked to see what was your average monthly expense, and were you staffing your business? Were you operationally built to handle the middle 6 months of your business? In other words, you've got 3 slow months, you have 3 busy months, and you have 6 normal months, where you set up to handle the 6 normal months. Now, it meant that you were understaffed in the 3 busy months, and you outsourced more, and you were probably a little bit more stressed out. And then you had 3 months of the year where you all sat around and twiddled your thumbs and looked at each other and pretended you were doing catch-up work. And those are primarily the things I would look out to see if you were organizationally efficient. That's all I was getting out of the numbers. That's not what I look at now. That's not what I look at all now. At all. People ask me all the time, what's the right revenue to FTE? And I said, I have no idea. Okay. It's whatever you happen to be at to do the work that you need to do profitably. So let's take a look at your business model and see if you're set up to do that efficiently or not. So here's what I do look at now. And this is not what makes me more efficient. Experience makes me more efficient at reviewing numbers, but also what we've learned over time and what we learned during the pandemic about building scalable businesses and balance also points to the numbers that matter most. So rather than every number mattering and trying to find the ones that are out of whack and see if we can put a little tweak there, a little tweak there, there's 5 big things I look at. Here they are. I look at revenue trends, right? I look at monthly revenue and profit for 36 months, okay? How seasonal is this business, okay? How often does revenue generate profit? In other words, we do a break-even analysis, okay? Is the revenue growing, flat, or declining relative to the economy? Now, one thing I do in there is I'm going to back out windfall jobs, right? Because that is not true growth. It's going to subsidize a busy month, but it's not the normal course of doing business. So I want to learn is this business proactive or reactive to growth, okay? Very often we will find that companies feel like their revenue is growing, and their revenue is growing, but their revenue is not growing as fast as the economy. And in fact, if their revenue is not growing as fast as the economy, but their expenses are, they're making less and less money every year. So I want to look at revenue trends. A top 25 customer analysis, or 80% of revenue, is extremely vital in understanding how this business manages revenue and what that revenue is going to be worth. So got to look at your revenue first. What's going on there? What are the trends? What is your reality versus what is your emotional feeling that we had a really big July, therefore we're having a great year, right? Within revenue, the second thing I look at is I look at ratios. I look at the ratio of key revenue sources, and I look at it over a period of time, not a single month, and God forbid, not a single job. I look at a trailing 12 months view of how much are you charging for labor and services? How much are you charging for revenue for owned equipment? Okay. And how much are you charging for logistics and other things that have direct costs like travel and trucking, et cetera, that apply to jobs? Those revenues, the ratios of them tell me a lot about your business. If the ratio of equipment is extremely high and logistics is low and labor is low, I expect I'm going to see a lower profit number. So if equipment revenue is more than 60% of total revenue, I'm going to find pricing problems, right? And I'm going to find that many companies undercharge for labor and logistics to subsidize their rental gross profit. And this is important information. The numbers are telling me that we're putting value in the wrong place, so that when we're really busy doing extremely valuable work, we're not actually making more money when we should be. The next thing I look at is cost of goods sold to revenue. Now, the challenge here is that most people's books aren't set up that way. A lot of people's revenue streams are not properly delineated. I have to go in and say, hey, if you're just putting a lump sum revenue, well, all our invoices are lump sum, so that's what we post. It's like, great, where's the breakdown? How did you get to that lump sum number? I need some detail. Well, the same thing has to do with cost of goods sold. For every revenue stream, there is a direct cost, and we need to see those align up clearly. We can't muddy the waters by lumping a bunch of things together. If you sell trucking, you need to have a line item in cost of goods sold for trucking costs, or it might be 3 line items or whatever it takes to capture all of that. I need to be able to do direct comparisons of revenue and the corresponding cost of goods sold. Great data in there. Very few companies have their books set up that way. It's awful. It's a crisis. We need to fix this. This is something we should be doing. I look at receivables to payables, right? This is getting into the balance sheet a little bit. How quickly is the company getting paid? How quickly do they pay? Is there enough cash to always pay on time? Okay. When owners are stressed out about cash flow, right, they are often distracted from the very issues that cause the cash flow problem in the first place. So we got this Ouroboros problem going on here. So very often we've got to nip that in the bud early in the project. So poor cash flow is almost always tied to low profitability. I can't fix low profitability overnight by repricing, but we can make other changes that will help alleviate that cash flow along the way. So the next thing I look at is the cost of selling. Now, this is not the cost of goods sold, and this is a term that gets used differently by different reporting systems. Some people call cost of selling cost of goods sold and vice versa. When I talk about cost of selling, I'm talking about below the line. In overhead expenses, you have money that you spend on marketing, business development, account management, commissions, promotions, sales, travel and incentives, proposal development. All of these things comprise the cost of selling. This is money you spend in order to earn revenue, to get that revenue. Now, what's a healthy percentage of selling expense to grow a business? Anyone? It's absolutely the right question, and I can't answer it for you. Most companies do not post their expenses this way. Their cost of selling is spread all over all sorts of different people in different places. They're not properly consolidated. They should be. This is critical to your business. So those are the things I love to look at. You can learn so much about a business so very, very quickly. However, many of my clients' numbers are not set up correctly to do this. Okay. This is why I'm holding the masterclass on management accounting. I mentioned at the header here, it's October 15th in Dallas. If you're an owner operator, you need to become your own managerial accountant. You need to get your books set up correctly. They were set up by your tax accountant in the beginning, or QuickBooks helped you set it up. They have no understanding of how your business works. We're going to talk about what you need to do to fix that. And then we're going to talk about how you use that information going forward. And the whole purpose of managerial accounting is being better at being predictive about results. So if you know that you're going to have a soft spot in revenue, we're going to see it in real time on your forecast. And if you need to make adjustments, you will know to do that. We're going to spend more time looking forward and learning how to do that effectively. It will lead to better results. It will lead to more profit. But we got to put the numbers in the right place. So please, I want you to come look at that and learn about that. Visit my website, trstimson.com/masterclass, or email me, learn more about this. And I look forward to seeing you there. This course is going to be the most important thing you can do for your business in terms of becoming consistently profitable. It will support all the decisions that you need to make about process changes on scalability and balance, and it'll help you sell it to the team because your numbers don't lie. Thanks for listening.
If you liked this episode of the Intentional Success Podcast, please leave a review and don't forget to like and subscribe. This podcast has been brought to you by the helpful folks at Mertz Crew.